Ashu Madan Dinshaw, thank you very much for coming all the way from Bombay and from Gurgaon. And thank you very much for being here with us. Catching up from where, we were both listening to Mr. Nawani talking, and he was talking about Gen Z. And in fact, we also were talking about Gen Zs and their approach towards investing. I want to get started with you, Ashu. What is it with this COVID trading generation? You were talking about a COVID trading generation. Could you elaborate on what do you mean by that, actually?
Yeah, I just learned a couple of jargons today. We were talking about Gen Z, so it was Gen Alpha, Gen Beta.
Yeah, even
I don't know, it could be Gen Gamma, Delta also will come. I don't know about it. But thanks to the speaker, I could learn few new jargons. So Gen Z, I just club them with the theme of long term, which has generally been the theme of, last many years of, ever since we have been into the markets, and you would have heard Rhythm also talking about investing. So thematically, it has always been long term. But looking at Gen Z, the current generation, which is a COVID generation, because 20 years we were struggling. We were struggling in the markets to have the participation. I still remember in 2000, we used to talk about that there's a huge penetration headroom available in India because of huge household saving and a fraction of household savings in the market. So there's a huge headroom available, 2000, 2005, 2010, 2015. For 20 years, we were struggling to get that participation in the market. What COVID did, nobody could do. Last 20 years, not that there were not initiatives by the government, everything was there, but what COVID did to the market, bringing in so many investors, because when COVID started, everything was shut, only markets were open. So that is the generation which entered the market. Now, currently, my only concern with Gen Z, or probably the current generation, I would say, I won't call them Gen Z, I would say it's a swipe generation.
Okay.
It's a swipe generation, and we are also becoming a kind of swipe generation. I'll give you one example. The real life examples that currently everything is becoming digital, and we have become addicted to that. Not we have become habitual, we have become addicted to that. Right from the Blinkit to everything, what we do is 10 minutes everything. I have a real-time example. If we book Uber, it shows 8 minutes. If it doesn't come in 10 minutes, bhaiya kahan ho? We immediately call, bhaiya kahan ho? So if you have ordered a Zomato, 20 minutes delivery, 22 minutes we call the rider, bhaiya kahan ho? And if there's a reel we are watching, if it's beyond one minute, we feel impatient that this is too long, a reel we can't, that's too long. Right. That has become the social construct. The life, it is actually, that has become a social construct. So my only concern is, in light of this, the definition of long term will also change. Right. What will it become? How will it become? It is a question mark. Probably Dinshaw will...
Yeah, that's where, in fact, I want to ask you. We were talking and you said, long-term investing is actually a myth. I really want you to elaborate this.
Well, let me elaborate a bit. So basically, first of all, thank you for having me out here on the India Economic Summit and in this lovely campus. It's fantastic. But anyway, let me continue with the long-term thesis. Now, the fact is that long-term, according to us, has been invented. That term has been invented to fool that gullible investor into believing that, look, you made short-term losses, but in the long term, you'll make profits. It doesn't work, right? So how do you overcome that? Actually, we don't believe in long-term. We always say that a long-term has to be a series of short terms which adds up to a long-term, right? Okay. Now, just to explain that further, now, suppose you bought a stock, right? By the way, in India, since long-term is at least not possible, right? Because we're such a dynamic economy that things change, right? And an emerging economy like ours, things change overnight, literally, right? So you have to now, what you've got to do is, when you've taken a position, you got to review your position every 3 to 6 months, right? And that's what we do internally also. We tell our analysts to come and refresh our view. And every 3 to 6 months, if we're convinced on that position, we carry it forward, right? And that's how you build up the long term. 3-6 months, adding up to a long term. That's how you overcome it. There's no other way of doing it.
So Ashu, what's your take on this? Because you wanted to add on this specific aspect.
There's a micro reason which I said that the social construct has changed. There's a macro reason also. Now the global economies are linked. Everything is linked. The competition is fierce. There are no sacred models. If there's an Ola, there's another Uber coming on the way. Uber will There's a Rapido coming, and then there's a Blue, which has shut down also. So these models will become successful also, and they probably will have threat of survival also. The competition will be very severe. Technology, ever-changing, technology can play havoc. So the definition of long-term has to change. I think, as Dinshaw rightly said, it suits certain section. So that is why probably it is more convenient, it is more safe, or probably it is less accountable also to talk about long-term. Otherwise, if you talk about test match also, I mean, test match led to 50 over game and 50 over T20, and now I've heard that Super 6 is 6 over. So that is why that even that has changed. In a test match, you cannot say that I will play on a 5th day. Let's see what happens on the 5th day. You have to go session by session. So probably that is the simile I can say what Dinshaw was saying, that you have to keep. You cannot remain passive with your portfolio, which used to be the case 30 years back, 20 years back, that my father bought Hindustan Lever or ITC or Asian Paint or whatever, and it kept on multiplying. I mean, today the models can change. You have seen that Asian Paint was down 30%, I mean, with such a comfortable position. So that's where I believe that this has to be addressed, and one has to adapt, evolve, and what will be the current challenges to the market in the light of this. See, Rhythm was talking about macro factor. I would say for me, biggest macro factor in last 10 years, what has changed for India is not the macro numbers stability, the political stability. All along, I mean, 30 years in the market, Dinshaw can say there was a time when, because of the coalition government or because of XYZ reason, I mean, policy paralysis or whatever you used to talk about, there was always something missing. And what this current government has given, I mean, this stability, government with a mission, government with a vision, I mean, things have changed very positive for India, and that is why we've seen this kind of a participation and where we have reached, and not to miss today's GDP numbers also. So that, in that construct, things are very fine, very good, very nice. But I mean, long-term thing will not happen, because you will get good opportunities, good spikes like 22 to 23, 24. Too good to be true profit was there in the market. But I think it is very important to, I mean, profit in the bank also.
Absolutely. Dinshaw, in fact, just we got the GDP numbers today. How does, from an investor point of view, how do these GDP numbers translate into real profit, real money in the bank for an Indian investor? What do we need to do as retail investors or as Indian institutional investors? How do you look at these numbers?
So, okay, Pranav, let me just point out this logo which I got.
I saw that.
Embroidered
that's
just for the IES, okay?
Okay.
And it's a saffron bull riding a crescent sun, okay? The fact is that what I want to portray out here is that it's India's day in the sun. There's going to be a bull run, and nobody can stop it, right? The GDP print that you saw today of 8.2%, actually, I was also a bit taken aback. I mean, as in the numbers were fantastic. I mean, and one thing that I want to highlight out here is for this quarter, why they are fantastic is that this quarter had a month of demand getting pushed out. If you guys remember, the rationalization, GST rationalization was announced on 15th of August, and actual implementation happened on 22nd of September. 1 month postponement, and despite that, you saw these numbers. I'm sure, as I was telling you the earlier time also, that the World Bank revised their numbers for India because first time around, when they saw the Q1 GDP numbers, they cut down the Q2 till Q4 numbers onwards, just to make sure that, okay, we don't go overboard. But with this 8.2% print, I don't have any doubts that not only the World Bank, but the world will get up and start looking at India again. And having said that, how do the investors capitalize on this? I think the best way to do is, and by the way, according to us, investing is not a hobby, it's a full-time job. So in case you don't have the time to devote to investing, leave it to the professionals. Go with the funds, go with mutual funds, go with professional managers, go with distributors who can advise you on where to invest and stuff like that. I think that's the best way of playing it. Do not try to do it individually. As I said, that you cannot just buy a stock and forget. You have to keep reviewing regularly, which if you don't have the time to do, don't do it. Come to managers.
I would really, request you to show that saffron bull for the camera, because it's still not visible.
Oh, okay. Sorry.
What are the, so it's saffron and it's a bull, so that's bullish because of a particular...
And in the sun.
And in the sun. What are the elements of this saffron bull? What are the underlying things that make this saffron bull so the success story of India? What are those elements? Both of you, please.
So, okay, let me go first. I'll just take your permission for that. So, the fact is that what I'm pretty excited about is the crowd sitting out here. All the generation Zs and Alphas to come later. But today, if you look at the labor pool, around a shade less than 30% is pre-millennials. I mean, the guys born before 80s, right? And thank God for that. Because we were, and I'm a pre-millennial, okay? I don't have any shame in saying that. But the fact is that we are born up on a diet of staple dialogues like, पाँव उतने ही लंबे करो जितनी चादर हो, or बूंद बूंद से घड़ा भरता है, and stuff like that. Basically, do not go beyond your means, period. Don't borrow. Borrow was a taboo. Borrowing money was, taking a loan was a taboo, right? And look at what happened afterwards. The millennials have no shame in borrowing money. They love, I mean, in fact, Generation Z, one of them was asking about work-life balance. I mean, that's it. I can't imagine myself at that age looking at a work-life balance. I was more of, how do I get more money, right? So, and these guys are now looking at leveraging their earnings, and that's what India needs, frankly. I mean, you don't need savings. You need to leverage those savings and work on those, right? So that's what is needed. In fact, I remember sitting through one of the stand-up comedians, and there was and I will repeat what he said. He said, I got my first salary home, and I told my dad that, look, my salary is come, now I'm going to borrow money and I'm going to buy a bike. And his dad told him, beta, start a FD. So he told his dad that, look, I can't sit on a FD and go on a date, right? I need to have a bike for that. And that's the attitude. I love that attitude. I think this is what's going to drive it. Fortunately for us, around 38% of the labor force today is Generation Z, and it's growing. What do they bring to the table? They bring, obviously, the fact that they look at brands as a way of expressing themselves. The woman participation in labor is what has gone up. And by the way, we men are useless in some way or the other, because it's been proven that if there's a working woman in a household, she's more brand conscious than a man is. We always look at discounts, and women do not. They look at price-quality relationship, and that's what helps. Formalization of economy. I mean, it's fantastic what's going to happen in the future. I think for the next decade, I don't have any doubts that India's GDP will be fastest growing going forward.
Okay. Ashu, what's your take on this?
So, I mean, I travel length and breadth of the country, and not just metros. I mean, tier 1, tier 2, tier 3. I mean, the smallest of cities possible. So what is very encouraging is the acceptance of market as a market as an investment tool, understanding the market. Everybody wants to be in the market in some way or the other. So that is very encouraging, and that shows the kind of penetration and now understanding. The only thing is how to bridge the last mile, which I think mutual funds are doing excellently.
But then I have, we're talking about the Gen Zs here, and he was talking about patience and not having patience. I would want to ask you, then, if there is someone sitting here who says, okay, I can do FNO, I can make more money, I can just buy a call of 2,000 rupees or a put of 2,000 rupees, and then that can turn into 2 lakh within minutes.
Yes.
How do you want to give your words of wisdom to that investor who's impatient and who does have avenues of earning more through these calls? And
so again, cricketing example, test match was investing, and monthly expiry is 50 over match, weekly expiry is T20. So everybody wants to play T20 in the market because that's glamorous, that's fancy, that's exciting. But my serious advice you would have seen that SEBI report where 90% of traders have lost money in derivatives. But for me, the key takeaway from that report was the 90% people who lost money, the average ticket size was 1 lakh, which shows the kind of money people have deployed in that market to play like a video game. Because a discount brokerage or a free brokerage, or it's easily available on an app, you're playing market like a Dream 11. Please don't do that. So for derivatives, if you ask me, is there a way to make money in derivatives? My answer is 100% yes. For investing, you need patience. For trading, you need discipline. So that discipline comes by experience or knowledge and education about derivatives, which is very limited to the majority of people. And that's my concern, is that is where SEBI is concerned about. So in a very crude way, I would say it needs a discipline and capital also. So my sincere advice to all the people who think that it is the easiest way to make money, it is the most difficult way to make most easy money in the market. And my one very crude way of presenting to them is, explaining them is, derivatives is one market जो अमीर को अमीर बना सकता है, गरीब को अमीर नहीं बना सकता. So you have to have a sufficient capital to play in derivatives, otherwise it is a zero-sum game for you. Otherwise you win some, you lose some, but that way derivatives are a very difficult market.
Okay. But then, Dinshaw, as someone who has seen the markets so closely, as someone who looks at, as someone who's witnessed how India looks at markets as a way of making money, is there really an easy way to make money, or a short way of making money?
No,
or wealth building, rather, to put it in a sophisticated manner?
Yeah, there is one way. You can give your money to Helios Mutual Fund and they'll be. So, but more seriously, on a more serious note, investing is all about elimination first, okay? And why I'm saying that is because actually in life it is very easy to identify what is bad. If I say that Ashu is a very good man, probably if you ask me why do you think he's a good man, and I'll tell you that probably because he doesn't sin, he doesn't steal, he doesn't fight, he doesn't abuse and stuff like that, right? All these factors are bad. So you know what is bad in life. Purely by eliminating bad, you come to a pool which is probably good. In investing also, that's how it works. There are bad managements, there are bad valuations, there are bad themes, there are bad accounting, bad corporate governance. Keep eliminating on those bases, and what you're left with is a pool that probably is not the best pool that you have, but it'll obviously take away the obvious bads from your vision, and you'll have a pool where the strike rate is much higher. But as I said, once again, this is not an easy task. You need a lot of experience. Like he said, that investing is all about experience, right? This is where it comes from. You just can't look at a man and say, oh, he's bad, because I don't like his face, right? You need to know his history, how he invested capital during times of growth, how he was borrowing during the times of recession and stuff like that, and take a call on the management. So for that, you need professional guys doing it. And as I said, that I think ideally, an individual who wants to be regularly invested in a market, he should probably go with a manager who has been regularly churning his portfolio around, making sure that the NAV keeps moving up. I think that's how it is. So,
if I have to ask you, what is, looking at the India story from where we are sitting right now, the saffron bull, if we talk about, which are those specific sectors that both of you are bullish on going forward for the next about 5 years?
So, should I take that first? Yeah. Thank you. So, actually, what India is going to do, there are a couple of other economies which have done it in the past, right? So if you rip off from their sheets of history, if you will, say a US or a China or a Germany or a Japan, when they saw this kind of a run that India is going to see, Japan was in, I think, in the 80s, China was in 2000s, mid of 2000 onwards, they started 2010s. US was 70s and stuff like that, yeah. So if you look at the sectors that did very well, were basically two. One was consumption, the second one was finance, right? Finance could be banks, financial services, insurance, and other ancillaries, right? Why they did so well? Because consumption is the only way forward for an economy to grow. External exports or infra can only help you that much. China learned it the hard way, right? They did a fantastic job in the 90s, but in the 2000s when they realized that they are stagnating, they let the consumption bull run through their own population as such. And by 2005, I think their GDP per capita was $2,600 or so. And then came 7, where it was $3,500, $3,600. Basically, the consumption just took off. And that was what led to that hockey stick curve in China. And I don't have any doubts that India is going to do the same, right? The internal consumption is what is going to drive it. We have an existing consumer base of 350 to 400 million consumers. They're all sitting out here, by the way. And these are aggressive consumers, right? They're not like as I again said, the pre-millennials who didn't want to spend out of the means. They want to go and leverage. So we're talking about a very massive base. I mean, we're talking about a population which is bigger than US put together, or the EU region itself, more than that. So that's a huge consumer base. So that's what's going to drive it. And why BFSI? I mean, banking, financial services, and insurance. Because that is what is going to fund that consumption. This is what is needed. So I have no doubt. And by the way, when I say consumption, it's not FMCG. Right? It's more of discretionary, more of healthcare, more of hospitality, tourism, and stuff like that. And why not FMCG? Because as I always say that just because you earn more doesn't mean that you will brush your teeth 4 times a day or take a bath 5 times a day, right? You can only do that much. But you'll go and buy new clothes, you'll go and buy new houses, new cars, and stuff like that. Yes, that's what I feel. So.
So I'll just extend what Dinshaw said. I mean, in same thematically, absolutely same. The only thing he has answered in a conventional way, I would say, so anything which is aggregating the population, which is consumption only, but I'm presenting in a different way. Anything which is aggregating the population and digital. That is why, whether it is Paytm or Nykaa or Eternal, or maybe aggregating the population, it could be exchange, where everyone is investing today, the BSC, or probably Indigo, you love it, you love them or hate them, but you can't avoid them, or maybe hotel tourism. I mean, Zindagi Na Milegi Dobara theme. So that theme is a consumption theme, and wherever the aggregation is of population is happening, and the way forward is digital. Those are the sectors which can really perform well. Only the risk involved is, there's no stock recommendation, my disclaimer, but the only risk involved is basically because they are highly competitive in nature, and as I said, that they are not there forever. The competition is fierce, so there would be absolutely great spikes and good tenures which you'll get to make good money, but don't, close your eyes and sleep over it. Money in the bank is the real money. So it's a consumption theme, but I would be more on a digital side who are aggregating the population, and the population itself is a great, input for them.
Okay. One final question, Dinshaw, you were mentioning in the afternoon, while you said that long-term investing is a myth, in a way that nobody ever asks those investors when to withdraw money. What is the right time to actually withdraw your invested money? I have put in money, it is multiplying. When is that moment when I'm going to actually withdraw my money? Okay, this is appreciated, this has become big, now I need to withdraw. When does that moment come in any investor's life?
Well, the market is driven by greed and fear. So it's always a big question when you want to be greedy and when you want to fear the markets, right? So that's how it is. But frankly, if you go with a professional guy, a professional manager, I remember when we were starting off a mutual fund way back in 23, and the question that I was going on being asked by most of the investors was, when do you redeem from a mutual fund? And I was thinking, why are they saying this? And then that's when I realized that they're worried because they just see the NAV. They don't see the churn behind that NAV, the kind of effort that goes in behind that NAV. And that's when we said, okay, we'll disclose you a portfolio every month, which is mandatory anyways. Now, what that shows to that investor is that, look, your NAV is moving because the manager is constantly taking calls on the investments. He's selling out the ones which he thinks are expensive or which have overdone themselves or where he's made a mistake. He's getting into newer stocks which he believes are underpriced or which he believes there's a growth story pending to happen going forward. There's a value discovery going to happen. So this kind of a churn, if you see your manager doing it regularly with a NAV upgrade, I think you never need to withdraw your money from there. That's why I always say that an individual stock can disappoint you, but a portfolio managed properly cannot, because here you're developing, when you develop a portfolio, you're basically trying to get these stocks which are going to run a marathon, right? But in a relay fashion. Obviously, there'll be some set of leaders which will try out at some point in time, but you need to have the second set ready to take over the baton from these leaders and run in the lead once they are tiring out. Give them some time to breathe so they come back into the lead again. That's how you develop a portfolio, and that's how you should be going with it. Thank you.
Ashu, we keep reading your JM Financial. In fact, read a lot of briefs. Rhythm Desai today gave a number. He says Sensex will touch 107,000. Would you want to probably share what kind of returns any investor, any Indian investor can expect over the next 5 years, 6 years, 10 years? Not a promise. Obviously, SEBI is there monitoring. We cannot promise any numbers. But from an analyst point of view, looking at history, can you say?
don't know, even SEBI is not watching. I mean, this is very difficult question to answer. I think I will, I will say over to Dinshaw. But generally, I'm saying I'm very optimistic of making money in the market. The routing could be different. I mean, it has to be a perfect mix of probably trading, investing, and a combination of all the products available. There is no thumb rule, no sacred model, as I said. And the only discipline which I believe that when to invest, you were asking Dinshaw, is I believe in a pyramid kind of an investing. So it should be a pyramid investing, when to withdraw the money, when the markets are down and out, when nobody is interested in that, when there's distress all across. That's where you should invest the maximum. And when there's a euphoria, when the narrative is that last year, mutual funds are sitting on 1.5 lakh crore of cash. SIP is at the highest, monthly SIP is the highest ever in the last 20 years. How the hell can market go down? Market still did go down. We have seen the correction, and today also the new high of 26,200 then and 26,200 now is very different. I mean, people are not celebrating as much as it was that time because of the money being made in the stocks. And today, if I say 61% of stocks listed have given negative returns till last year, in spite of hitting new high. So pyramid investing, but normally in our kind of a market, what happens is it is the reverse pyramid. You start with 100 rupees, you get complacent and you keep investing more, and when the euphoria is at the peak, you are at the highest investment. Right. So the only discipline which I follow for investor is stay invested forever or for long term, because you are in this business, but keep churning the size of your portfolio.
Right.
Size of the portfolio, and that is the pyramid or the reverse pyramid. That discipline is very important, which I follow diligently since last 20, 30 years, and that is what has helped me.
Dinshaw, sorry.
Should I take a strike at that?
Yeah, please.
So basically, last 20, 25 year average growth in our index growth is around 13%, okay? This is all history, right? But as SEBI tells us to say, that past performance is no indication of future, right? So let's keep that in mind. But that 13% came because our nominal growth, GDP growth, was around 10.5, 11%, right? 6.5% of GDP growth plus 4.5% of your inflation, right? So nominal GDP was around 10.5, 11%. The index growth was at 13, mainly because index doesn't have this composition called agri, right? Agri growth was much lower than the GDP growth, and that's the reason why the index, which is composing some mainly of manufacturing and services, grows slightly higher than the GDP growth. If the GDP growth continues the way it is, I don't have any problems in saying that this is what the kind of growth you'll see, early teens kind of growth. And frankly, if it's going to grow higher, the GDP has to grow higher. That's how it's going to be. So
okay, one final question to both of you is that we've seen all the rise that over the past about a few months from September to once again to hit a fresh high has all been driven by domestic investors, all DII, all mutual funds. The retail investor, whatever the in-house investor. If we really see the foreign institutional investor return, do we see that happening now? Is the FII finally back, and will that be a reason to fuel a further rally in the market? Both of you as concluding remarks on this.
So they moved out sometime from October of last year, right? The reason was that our earnings growth were dipping and our valuations are very high, right? That was what happened. In fact, September of last year was the first quarter of negative growth after a very long time, right? Obviously, that panicked them and they started moving out of India as such. And now look at the quarter gone by, right? September. I think that was the first quarter which gave an indication of growth. And frankly, 8.2% GDP is a reflection of that, right? So if you look at the composition of NSE 500, right? 100 stocks are large cap in that 500. Those 100 stocks grew, the earnings of those 100 stocks grew at 10%. That's large cap universe. You look at the 150 mid caps that are there in the 500, that 150 mid caps their earnings grew at 25%. I'm talking about this quarter. And then come to the last set of 250 stocks, which are small caps. They grew at 37%. These are mind-blowing numbers. They're not small numbers. Again, let me remind you, 1 month was lost because of demand getting pushed out, right? So despite that, you saw those numbers. Now, what has happened is India has massively underperformed the MSCI Emerging Market Index, right? The peak underperformance was 30%. Today, we are at around 20% underperformance. Normally in history, one has seen that whenever these underperformances happen, the rebound also is pretty high. I'm not sure when it's going to happen, but that's mainly driven by FIs coming back, because today our forward PEs are much more reasonable. Our premiums are down to reasonable levels, and the earnings growth are kicking in. So I have no doubts that they'll come back.
Wonderful.
So Pranav, I would say that very optimistic, because one, consolidation has happened in the last 1 year. Weaker hands are out. India is in a sweet spot. Earnings are turning around. So everything is in favor. But the only thing which is the caveat is, in spite of that, I mean, at times we feel frustrated that everything is good. India is in a sweet spot. Why are they selling? I mean, you don't get a very credible answer. But I think the reason is, it is because they are opportunists. And elsewhere in the world, they are making more money. So till that phenomena continues, I think we should be hopeful, wishful, and maybe at some point in time, we get a very positive surprise and things turning around. But I think for me, the biggest reason is that irrespective of all the positives with India, whether it is economy, government's vision, mission, and markets, corporates doing very well, but as an investor or a trader, they are making more money somewhere else, which is what is hampering an infusion of capital or the things turning around. So I think that is something to be watched for.
Thank you very much, gentlemen. Thanks a lot for being with us and sharing your wisdom, not just with people here, but our audience on television broadcast as well as social media and digital. Thank you very much. Thanks.
Thank you.